Toronto, our composite index trading once again in record territory today. But of course, unlike the US, where big tech has been driving gains over the past year and more, Toronto's rally is more broad-based. Let's get perspective from Dan Rohinton, portfolio manager at IA Global Asset Management. Always great to see you. Thanks for joining us. We don't have these mega techs, but we are getting something of a rally in Toronto. We're seeing new record highs again.
Yeah, that's right. And it's in some ways there's some similarities. So it is a concentrated rally. You're seeing it, especially this year, in the energy and the material space. And the area where it is a little bit different is consumer staples, which is a lot heavier on the grocers and the convenience stores. In Canada, that's also been a source of strength on the TSX. So it's not quite Magnificent Seven, but it's our version of it.
Yeah, that's interesting. The likes of Loblaws, the retailer, hitting record highs, and Royal Bank nearly in record territory as well. So we finally have a market that's playing catch up to the US.
There's about 25% more to go, Andy. So it is there's quite a lot of catch up to the S&P 500, but I'd say this is a good start. And some of the end drivers and the underlying drivers, so some of the expectations around a bit of a softer economic landing, that Goldilocks scenario, that's more constructive for energy prices. A more dovish Fed, that's more constructive for gold. And then data center demand, which copper is a third derivative proxy of, is part of it, part of the benefits as well. So we're seeing some similarities and for some similar reasons, but just at a lower beta versus the S&P 500.
And that's a good thing, I suppose, a lower beta.
Yep, that's right. More often than not.
It's interesting as well, yeah, for once, well, I mean, I say for once, we've been lagging the US, but paradoxically, almost copper is now seen as something of a tech play if we keep getting growing AI-driven electricity demand.
Yeah, and what used to be the driver, why it was called Dr. Copper in the past, was because it was driven by core industrial production, especially driven by China. Now the demand sources of copper have changed to shifting more towards, call it, electrification. And you need a lot of copper in the data centers as well. Mm-hmm. So it's become, call it, a more of a new economy, economic and industrial reinvigoration play. Do I think sometimes that narrative gets a little bit stretched? I do. But for what it's worth, that's why copper has been on the tear that it has been more recently.
It's interesting. CIBC notes today that Google has been going a little mumbly, watering down some of its net zero commitments. Partly, CIBC thinks, because AI is swallowing up so much electricity.
Yeah, and you need so much more generation capacity for that. And copper plays a role in really building those things out. But in general, if AI comes to pass in the way that investors hope so today, you need a lot more generation capacity. So that requires effectively as much solar, wind, and even natural gas in the future as you could possibly build.
Talk to us about Agnico Eagle. The gold stocks have been on a roll. Gold is back near record highs, trading above $2,400 a US an ounce. Agnico is one of your favorites here.
Yeah, and what makes Agnico unique is its stability, its safety, and its capital discipline. So one of the reasons why the actual intermediates, the juniors, and some of the seniors don't perform as well as the metal over time is that management teams tend to get too excited during the good times and too bearish during the bad times. So it's the misallocation of capital and the suboptimal uses of capital that really create those extra risks. Because a miner, especially a senior one, should have that stability, and that's exactly what Agnico is. So you're in safe jurisdictions, and management's made the commitment, which I would expect that they hold themselves to actually return the gains of the metal through the margins and pass it on to shareholders. So that's what makes Agnico unique, is if you have to own a gold miner, make sure that the mine is in a safe jurisdiction, the costs are under control, and you're going to actually get the operating leverage that comes from the metal prices going up through the profit and loss statement into shareholder return.
Just give that to me again. So Agnico, in your view, is leveraged to the price of gold. Why would other companies not be?
They are, but you have to remember management teams tend to have beta to the upside and downside. So when gold prices are going up, you run the risk of a management team doing a major acquisition of a junior miner, or maybe taking the opportunity to massively expand production. So you have this, call it this bullwhip effect, where you basically have some of the gains in the metal, if not all the gains in the metal itself, not actually coming back to shareholders in cash flow, dividends, and buybacks. It gets quote unquote reinvested into the next big thing. And that's the good news about Agnico is I'm not worried about that. And that's why it's in the Canadian portfolios.
The Franco-Nevada, it was a darling among precious metals for investors for a long time. And then, of course, it took a hit when the Cobre Panama mine was closed. But you think it's a buy right now?
I think it's a speculative buy because what you have is you have, generally speaking, the same old Franco with the quality balance sheet, the streaming assets, and the history of countercyclical capital allocation, which is a good thing. And you have the optionality that Cobre Panama, which used to be 25% of the NAV and was written down, which was a loss of, I believe, $5.11 a share more recently. If that mine reopens, you have the same old Franco. Plus, you have the optionality of Cobre Panama, which is a major copper asset where Franco gets the streaming of the gold streaming rights from. So you have the upside, but it is more speculative. So if you have to own gold and have a little bit more risk to play with in your budget, then Franco might fit there.